Hi, everyone. Welcome to Questrade's webinar series. Thank you for joining us. My name is John, and I'm your host from the Questrade education team. And joining me shortly is our special guest, Jessica Inskip from OptionsPlay. Before we get started, let's quickly go through some important notes and a disclaimer. So today's session will be recorded and we'll have the on-demand version available early next week. If you have to duck out early or would like to rewatch an important section, we've got you covered. Keep an eye on your email inbox for the recording. If you have any questions during the presentation, please type them into the Q&A window available at the bottom of the Zoom interface. That's the Q&A and not the chat window. Thank you. Our agents can help answer simpler questions throughout the presentation, and Jessica and I will be hosting a longer question and answer period near the end of the webinar today. And if you're having technical issues or have general questions about Questrade or trading, please feel free to message one of our Questrade support agents via direct chat. And here's a quick disclaimer. Now, please remember the information conveyed in this webinar is for informational, educational purposes only and does not constitute advice or recommendations by Questrade. Now, without further ado, I'd like to introduce our guest speaker today, Jessica Inskip. Jessica is the Director of Product and Education at OptionsPlay and has been a prominent figure in the online brokerage industry for the last 13 plus years. She specializes in options and derivatives, and her main passion is investor education. We're very excited to have her here to present today. And with that, I'd like to pass it off for the main event. Thanks, everyone.
Thank you, John, and thank you, Questrade and TMX for hosting this event. I'm really excited to share this with you and go through a lot of Options 101. So it's going to be a really great session, really informative. We spent a lot of time putting together some really great illustrations to ensure that everything is put together really well. So I'm really excited for this one. So let me go ahead and share my screen with you. All right. So we too start with a disclaimer, which is important. So types of securities and forms of research tools within this video are for demonstration purposes only, and they should not be considered a recommendation by OptionsPlay or myself or a solicitation to buy or sell any securities. It's not intended for tax, legal, or investment planning advice. We are a third party not affiliated with Questrade or TMX. And there are a lot of examples throughout. They don't include any commissions or fees, and no opinions are affiliated. That's the important part here. So as far as what we're going to cover today, this is an Options 101 course. So if you are new to options, or maybe you've traded them before, you want to understand the anatomy of them or some of the intricate details, then this webinar is essentially for you. What we're going to cover is the anatomy of an option. We'll go over the pricing components and review an options chain utilizing Questrade's platform. We'll go through long and short equity calls, long and short equity puts, and of course save Q&A for the end. So there's a lot of content that's in here that we're going to put together, but hopefully I hope you get some positive results from it. So before we dive in, I would love to just put out a poll to everyone to understand exactly your options level. So what we're going to put out is, have you ever traded options before? And if you don't mind, all right. Got a lot coming in. The vast majority is totally new to this, which is great. That's what this is intended for. So that's great to hear. Some frequent and a few times. All right, got about in the 80s participation. Great. Thank you for sharing that. It certainly helps to make sure that we're there. I know I've been trading options for quite a long time, and I've had the wonderful, or I guess the pleasure of learning from so many great people. And so that's where my passion really developed from. And that's what I want to share with you, is those light bulb moments and little tips and tricks that really help you understand the anatomy and options and how they work and the logic behind it. That's really beautiful. People who don't know me personally, I've got actually an engineering and a mathematical background, and that I love to apply that to options. So we'll go through that in a lot of detail. So let's start with the anatomy of an option. So an option is essentially a contract between two parties, a buyer and a seller. And with every contract, there are terms associated with it. And so we utilize options to determine just that. So when you have a contract, you ask yourself, what are we agreeing on? what product are we agreeing on, what price are we agreeing on, and what time frame are we agreeing on. So just like a normal contract you would between two parties. It could be a coupon, it could be a home, things. There's lots of analogies that you can utilize. With options, the quantity is referred to as the contract amount. One contract generally represents 100 shares. The product is represented by the underlying security. That can be a stock, exchange traded product, say product because it could be a fund or a note, an index, currency, commodity, futures. There's lots of products that options are traded on. The price is referred to as the strike price, and that is priced per share. So that's really important when you're looking at a contract. We're going to look at it on a per share basis, but it always represents a round lot, which is 100 shares of an underlying security. The time frame is simply the expiration date, and that's normally on Fridays, but they could be weekly, quarterly, monthly. There are lots of issues on options. So with a real example, the quantity would be 1, that would represent 100 shares. We're going to use ABC or XYZ throughout to keep it evergreen and the easy math with $100 strike prices. And I'm going to look at things with a 30-day expiration, but I know the dates may not match, so we'll make sure that I do that. The DTE is something you may see in the options world quite often. That simply means days until expiration. So if we have this here, this just means that we've got one contract that's worth 100 shares of ABC at a $100 strike price. That's good for 30 days. That contract is issued as a call or a put, and that's what determines if it contains the right to buy or the right to sell. The contract can be exercised. So that just means execute upon the terms. So if you have a contract, you can invoke that and invoke that right. So if we were to exercise the call, that represents the right to buy. That means I'm going to buy 100 shares of AB stock at 100 per share at any time in the case of an equity option before the expiration period. Does it make sense or necessarily? That's a whole nother question that we'll review. But what you need to understand is if it's issued as a call, it simply means it contains the right to buy. And if it's issued as a put, it contains the right to sell. It can also expire. So if you choose not to execute upon those terms of those contracts, it will expire worthless at some point. And that's where it really differs from a stock. A stock, theoretically, you can hold forever, but a contract has an expiration date. And we'll talk about the importance of that when we get into the pricing component. But it at some point will cease to exist, which goes into the logic that is inherent of options. The final thing that you can do with an option is trade it. And this is the vast majority. The last data that the OCC released, I believe, was around 70% of options are actually traded. So meaning when you buy the contract, you sell to close it, or you close the contract on the market rather than actually executing upon the terms or allowing them to expire. And please know that allowing an option to expire may essentially be your goal, which is what we'll talk about as well. So the contract then, all of this is issued for a premium, which is the price that the option is worth. So that's the next part of this presentation is we're going to go through what represents that options premium. And I will say the best way to learn about options is by learning a long call. And I'm going to show you how a really great trick. I learned it when I got my Series 7. When you're in call centers, sometimes you see them everywhere for people who talk about options. So it's a really great tool to utilize when learning about options. So the way I have that is this T-chart. So the way that we look at the T-chart is we have long calls and calls on the left, puts are on the right. Anything in the top quadrants are bullish and on the bottom are bearish. And you'll see something that is kind of inherent when they're on either end. And I actually utilize this when talking about options all the way to the Greeks, any strategy. I like to think of options as with a lot of analogies, but essentially long options have an ownership component. So they contain the right to buy or the right to sell. The analogy I like to use is driving a car. If you're driving a car, you are making the decisions to go left or right. Ultimately, you are the one who's turning the wheel, hitting the brake, stepping on the gas pedal, whatever it is, you are the driver in that situation making the decision. That is also the long option holder. It is their discretion and they can exercise that contract on their terms. The short option holder is essentially the passenger. So they can think about when you're in a car and you're in the passenger side, you can see who is going around you. You might see if there's a stop sign all of a sudden. You might get an indication if the driver is going to go left or right, do their blinker. So the point is there are a lot of surrounding components for you to get an idea if what the driver is going to do. So the short option holder is obligated to fulfill the terms for the other side of the contract. You don't need to remember all of that right away. It takes a couple of sessions to really learn options. And I encourage you to review this when we go through it in further detail or when it's sent out later. But what I want you to focus on is this is a mirror image. This stays very consistent. If you understand a long call that contains the right to buy, you can utilize this chart to understand the rest. So we're going to focus on that for now, and we'll go into details of all four individual strategies. All right, so let's talk about that premium component. So an option is priced by what is called a premium. A premium is made up of two components, which is intrinsic value and extrinsic value. The intrinsic value is the in the money value, which is just literally what is the contract worth. So if I own the right to buy ABC at 100 and ABC is trading at 105, that contract has to be worth at least $5 per share because I can buy it at a more advantageous price utilizing the options contract than what the market is pricing. That is called in the money. It's actual value. That value could be zero. But that is just literally, this is how much your option is actually worth if you were to execute upon those terms. So very simple there. Extrinsic value is made up of two other components. The first is time value. So oftentimes extrinsic value is referred to as time value with the more literal sense. I like to separate it into the two, but we'll go through that in one moment. But more time until expiration is a component of that time value. And think about that. If you have an option that expires within 30 days and an option that expires within 60 days, that option that expires within 60 days has to be more expensive than the option that expires within 30 days. And that's logical. You have more time for it to be above or below your strike. Therefore, it's going to be more expensive. And that's a decaying component of the option because unfortunately, I don't have the time machine. None of us do. Therefore, that's constant. That as time goes on, that option decays. And that's an important component. And one of the most common questions I get asked all the time is how come my option is not moving with the underlying security? And that's because your options premium is made up than more than just the underlying security component. There's that time value component and implied volatility. So think about earnings. We just got through a huge earning weeks. I think there was about 160 reporting last week on the S&P 500. So there's a ton of implied volatility that happens. And what that means is, well, the textbook definition of that is the market's forecast of a likely movement, the security going above or below the strike. That's it. So a likely movement. So with earnings, you know that there is a date. You know that there is an analyst expectation. And we're looking for it to meet those expectations. If it does not meet those expectations, the stock or underlying security is going to move above or below drastically. So we expect a huge movement up or down. That is implied volatility because you're more likely to move above or below your strike. It's going to be more expensive. And that's an implied volatility component of the options premium. And that's why a lot of people get in trouble trading options around earnings because they experience implied volatility crush. Once those earnings report, the premium is deflated. And even if they did great, you need your option to move more because of that implied volatility component, which is something just for the purpose of this presentation and introductory, you just need to know that there are other factors besides the underlying security that affect the price of your options. Within this illustration, the way that I like to describe this is anything that's intrinsic is internal factors that affect that option. So that the internal factor and the component of that option is ABC, or the underlying security. External are things outside of your control, which are time and implied volatility. Earnings is just an example. It could be if someone decides to make a tweet, or there's a news release, or there's lots of reasons where there's an anticipated movement, and that's going to cause options to be more expensive. And that's an important thing to note. So let's look at that with some examples. So I've got ABC at 103, and I'm going to use that 30 days until expiration throughout. But ABC, so let's say we've got an option with a $100 strike price with 30 days left until expiration, pricing at $5 per share. So what's the in the money value? What's the extrinsic value? So if I have the right to buy at 100 and ABC is at 103, the difference of those is 3. So that has to be my in the money value of the option. The option though, however, is at 5, so a premium of 5. So therefore the difference of those two becomes the extrinsic value component. So this is a decaying piece of your contract, and that's what's important to know, and that's what I want you to take away, is the way the option is priced is there are 2 components, intrinsic, extrinsic. One is working against you. If you're an option buyer, it's decaying as time goes away. It's going to deplete in value, and you buying an option, you want to buy low, sell high. And the intrinsic value is the component of the option that moves with the underlying security. So the actual value of the stock. So I'm going to get this off the screen so I don't give you too many answers. And I'm going to give you just a quick knowledge check to gauge before we move on to the next section. So I'm going to launch that. So if XYZ is at 56 and we have a $55 strike XYZ call at a premium of 3, it's in the money by what amount? So remember, a call represents the right to buy, and we have the right to buy at 55. And I did throw some things in here to throw you off with purpose, of course. So it's pretty evenly dispersed. Got about 64 participation. I'm going to leave it there. Okay, the answer is $1. So remember, if you have the right to buy at 55 and the market's at 56, in the money is the intrinsic value. And so therefore the intrinsic value of the option is $1. Because I have the right to buy at 55 and could immediately sell at the market at 56. Therefore, we know this option has to be worth at least $1. The $3 component of the premium, so the difference, the $2, is actually extrinsic value, and it is made up of time value and implied volatility. So put together. So there's a lot of varying factors that are involved, but the important part is this is what it's actually worth. This is how much it should be worth. If you put in a limit order on expiration, that's how much it should be worth. And as long as a market exists, you should be able to get an execution for that. But that's an important factor as well when you have an option on expiration, because they are a depleting asset, meaning there is a time value component that eventually will end and it will cease to exist. When an option reaches its expiration period, it is only going to be worth its in the money value. There are some weird one-off circumstances where implied volatility can come in, but for the vast majority of the time, it is worth at least its in the money value. That other component is going to deplete, and it's not linear either, which is a common misconception. Time value is more of a cliff, if you will. So it depletes and decays, but when it gets right to the end of its expiration, it just falls right off of a cliff and it's gone. And then I do see a question out there about implied volatility. That is probably a whole nother webinar on itself as far as how it works. But the important part is when an option has earnings is the best example. And you can pull up an option chain and see, actually it's right here on this option chain. This is an implied volatility factor. So this underlying security right here, Suncor, this is normal for SunCar, but if there was earnings coming up, this may be 150 or something like that, and these prices are going to be a little higher. And that's the underlying component of implied volatility, or a good way to gauge it. But like I said, that's you can get so advanced when you get into implied volatility. The important part is it's the pricing component of your option. If implied volatility is higher, that means your option is going to be higher, which is bad if you're buying an option because you have to recoup some of that back. So let's look at an option chain. So hopefully you've got a better understanding of how an option is priced. Let me show you how to read an option chain and gauge those prices utilizing Questrade's platform. So calls are generally on the left and puts are on the right. The strike price is right in the middle. So this is what it represents. So the right to buy would be a call, the right to sell is a put at what price is represented here. At Questrade, you've actually got a great platform that's built for options traders, as I was playing around with it before this webinar. So there's some really great customizable features actually on this options chain that a lot of brokers don't have online that you can add. So I think that's important to point out. You can choose your expiration with a couple ways. You can do it by this drop-down menu, or it's also by collapsing and expanding, but that's how you see your expiration. There's also days to expiration over at the end, and I think that's important as well. But if you're looking at an option chain, you should be able to see as you go further down the option chain, the more expensive that those same options are, just with a farther out expiration date. And that should hopefully put together those pricing components. All right, and there is a good question in there. The price of the option. So yes, and I apologize, I didn't cover that. If your premium is $3, since it represents 100 shares, that means you're spending $300 total on that option. So you can look at it as a price per share basis for an understanding, but always multiply it times how many contracts you have times 100. So looking at a long equity call, and let's assume that these are 30 days from now, even though I know May 20th is not 30 days from now. I do use real prices for these examples, but I normalize them just for easy math and to keep it evergreen utilizing ABC. So if we have a long equity call, and I'm going to spend the most time on this because remember, if you utilize that T-chart, if we know a long equity call really well, we can figure out the rest. But the secret to understanding options is knowing a long equity call inside and out. I can't stress that enough. So I'm going to go through all of the 4 components. Just know that it's to show you, but the one that you need to really focus on is the long equity call. So we have a long equity call, and just like in a trade ticket, if you wanted to purchase the long equity call, we're going to buy to open one ABC call expiring on May 20th at a strike price of $150 for $7 per share. So this means that I own the right to buy 100 shares of ABC at any time up until May 20th. And in order for that right, I paid a debit of $7 or $700 total. So this is the profit and loss diagram that we'd use to describe a long equity call. You'll see a lot of these around, and they shift the way that you layer strategies together, but it's a really great view of what you need the option to do in order to capitalize on it. So from a long equity call perspective, our strike price is at $150. Oh, and this is represented on expiration. Mind you, there are other factors. But because I have the right to buy at $150, by expiration, I need ABC to move more than $7. So more than 157. Otherwise, I'm going to break even. And that's not enough. So my gains will actually begin once ABC moves past 157. And it has unlimited gain potential. Just like if you own an underlying security or you were to own ABC, it could theoretically go to an infinite price. The difference is you have a time frame associated with this, and you have this $7 premium that you have to account for that you're not going to make dollar for dollar as ABC goes up. So your max risk is if ABC were to remain at 150 or below 150, Your break even is if it moves 150 plus the amount of the premium paid, and this is at expiration, and you have unlimited gain potential once it begins to move beyond that break even point. So that should be hopefully put some things together. There is that pricing component, this $7, this contract has 0 in the money value from where this is right now. If it was at 150, we have the right to buy at 150. That isn't worth anything. We need the underlying to move more than the strike price, more than the premium that I paid for this option. And that's the important component that I need you to retain from this. So now we're gonna flip everything upside down and move to the other side, which is a short equity call. So if I'm on the other side of that option contract and I'm selling one ABC call expiring on May 20th with strike price 157, I'm obligated to sell those shares at the buyer's discretion at any time. I have an obligation, I don't own it. So that means at any time, I may have to sell 100 shares of ABC. ABC may, so when you sell at ABC, know that that's extremely important. There could be unlimited risk potential. There is unlimited risk potential. This is the only option strategy that actually includes unlimited risk potential. And so anytime you have a short equity call and it's not covered by some type of offsetting long position, which is normally a short equity call, this has unlimited loss potential. And so I want you to take a look at remember the long equity call and what happens there. You have the right to buy at 100. The short equity call holder has the obligation to sell at 100. They receive that premium as a credit. So they're keeping that $700, but they are hoping for it to decay. That is an extremely important component, is they would like for that to decay. They have, and you notice that this is almost, I flipped, and that's where that T chart really shows and validates how everything is essentially a mirror. You have limited gain potential, so not unlimited gain potential, but limited gain potential. ABC needs to move lower or remain at that strike price, because remember, you don't want the contract to have any value if you're a short equity seller or a short option seller. Your goal is for the option to just deplete, not be worthless. So you mean those terms or the contract terms that contract contains, you do not want it to have any value. You don't want it to be exercised upon. You just want it to expire worthless. You break even actually at the same spot. So in this scenario, 157. So if the underlying security, as it moves up, your loss potential starts to begin. You are breaking even as soon as the underlying security reaches 157. And as the underlying security moves beyond 157, you actually have unlimited loss potential. And that unlimited loss potential, think about that. Because you have an obligation to sell the shares at 100, theoretically, that underlying security can go to an infinite price. And if ABC were to go to $400 per share, which is an extreme example, but you may have to buy those shares at the market for $400 in order to meet your obligation, and you're selling at a predetermined price of 150. And that's the important part that I want you to take into account there, is if the eyes of the person who is along the option is how we determine if it will be executed upon. So if the ABC stock was at $400 per share, it would make sense for you to exercise the terms of your contract and buy at 150 and sell in the market at 400. And so that short equity call holder would not profit in that situation. So there's unlimited loss potential for the short equity call holder. There is unlimited gain potential for the long equity call holder. So that's the important component there. All right, so let's go into some actual examples with some time frames. And then I'm gonna add something additional here, which is a price target. And I think that's important to know. So we've got two traders, a long call purchaser and a short call writer, and they are both utilizing this or trading the same contract. So we've got one ABC call expiring on May 20th at a strike of 150 for $7 per share. The long call purchaser is bullish, which makes sense. They have unlimited gain potential if the underlying moves more than the strike plus the premium. They have a price target in this situation for 165. So they're assuming ABC is going to go to 165, and they feel like that's going to happen in a 30-day time frame. The short call writer is neutral to bearish. They've decided on the other side of that trade, I think ABC is going to stay the same, and I think that's going to happen within a 30-day time frame. So what is going to happen here? So if ABC is at 150, both place the trade. The long call purchaser is going to buy to open one ABC 50 May 20th call at 70, or excuse me, at 7, so a total of 700. They're going to pay $7, 700 total. The short call writer is going to sell to open one ABC 150 May 20th call at 7, and they're going to receive a premium of $700 per, or excuse me, total $7 per share. So that both have the same break even, both have 30 days to be profitable. So we've got this time frame of where we feel like the security is going to go. Going to day 15, so we haven't reached our expiration period, but we're halfway there. ABC did reach the price target of the long call purchaser. So the long call purchaser was able to sell to close their call for $17 and received $1,700 total, which is a gain of $10 per share. So the difference of the premium paid and the premium received. The short call writer decided to buy to close that option and paid a premium of 17. So they had a loss of $10 per share. So $1,000 total, excuse me. And since this is day 15, you'll notice that there is $2 worth of extrinsic value that the long call holder was to recoup, because if we have the right to buy at 150 and ABC is at 165, that represents $15 of intrinsic value or in the money value. That additional $2 that's within this premium is extrinsic value that the long call holder was able to recoup because they purchased time value. So closing out that option when it hits a price target is rather advantageous because they can recoup time value purchased. It's not often that options traders hold until expiration, and there are a lot of other risks involved with that. The short call writer, though, the time decay is something they could capitalize on, but because they face unlimited risk potential in this situation, they decided to close early because this loss can go to an astronomical price, where if this loss is limited to $700. So I hope that example helps clarify a short call. And we'll go through another one as well on expiration. So let's say at expiration, it just moved up $1 more, so to 166. Here's what happened here. Because that time value component completely depleted, the long call purchaser actually received $100 less because it went up $1. Remember, there was $2 of extrinsic value before. Now there's no extrinsic value because we're at expiration. There's no time value left. Time has depleted. That makes perfect sense. So if we own the right to buy at 150, can sell at 166, that means that this contract has to be worth at least $16, which is what it is. So the long call holder made 900, and the short call writer did capitalize on that time decay component. Even though the underlying went up $1 more, they essentially made that difference of 200. So 900 total was their loss rather than 1,000. And that 200 being the extrinsic value depleting. So let's look at another scenario. So if we have an equity call and say on day 15, it actually was sideways and went to 150. So this is the same trade. Because it's at the money is what we would call that. So an at the money option is an option that is at relative terms to the strike, but the same price as the underlying. So buying at 150 is the same price as the market. Therefore, this is an at the money option. It's not more advantageous, nor is it less. It's the same. So everything made up of this premium is considered extrinsic value. Extrinsic value is going to deplete and hurt the long call holder and deplete and help the short call writer. But the long call purchaser had a price target of 165. It did not reach 165. In fact, it just stayed exactly the same. They've decided, you know what? There's time value associated with this option. I'm going to go ahead and close it early, mitigate my full loss of $700 to $200 because I can recoup $500 right now, which is that time value. The short call writer, remember, they face that unlimited risk potential, which is extremely important. They capitalized on the fact that they were right, and the time value component not completely depleted, but $2 of that depleted. So they were able to buy back that option at a lower price than what they sold it for, capitalizing on a gain of $200 per share. So let's see what happens on expiration. So if on expiration, let's say it went to 145, you would not be able to close that option. You could try, but a market's very likely not going to exist because someone's got to take the other side of that trade. So if you're selling or buying the right to buy at 150 and ABC is at 145 and that option expires that day, it's very, very unlikely that you'll be able to close that option. So essentially what would happen is the long call purchaser would realize their maximum loss of $700 per share. The short call writer will realize their maximum gain of $700 per share. Both would expire worthless, which is bad for the long call purchaser, but is the ultimate goal of the short call writer. All right. So I'm going to go into long equity puts now. And if you are new to this, I will say going from calls to puts can certainly cause a ton of confusion. So just know that a put, all it is we're switching everything instead of the right to buy to the right to sell. So if I buy to open one ABC put expiring on May 20th at a strike price of 150 for 7, that just means I own the right to sell because it's a put. And if I have the right to sell at any time for 150 per share until May 20th, I am paying a debit because I own the right to sell. And so that's 700 total. So this is flipped, and on the profit and loss diagrams, this represents the stock price moving up, and then this is considered loss, and this is considered gain. So in this example, your max risk, or remember, because this is a bearish position because you want the security to go down, you profit when the stock goes down below your strike price. You can see how it's similar there. Your max risk is if the ABC or the underlying starts moving up. Because you're bearish, you need the underlying to move lower than 150, perhaps recoup some time value that we just learned, but at expiration, you need it at bare minimum to move more than the premium paid, which is $7. So that's where this difference between 150 and 143 is, in order to have gain potential. Now, so there isn't unlimited gain potential because the stock can only go to 0. So if I own the right to sell at 150 and I could buy at a very, very, very low price, it's substantial gain potential involved with the put. The short equity put is a bullish position, so we'll flip it there. Remember, this is the selling side of the option. So this simply means that the obligation is there. So now I'm in the passenger side of the options contract. This is a bullish position. We want the underlying to remain at the strike or move higher, because that means that the contract will be worthless, which is our goal when we're selling an option. If ABC moved to 160 per share, owning the right to sell at 150 is not going to be worth anything. So that's how this is a bullish strategy, is we want it to be worthless. Therefore, having the right to sell at something at a lower price in the market makes it worthless. The profit and loss here is the same break-even price, because we have the obligation to purchase the 100 shares. If the long put holder decides to exercise the terms of the contract and sell those shares, we have to purchase them from them. So our break-even is at 143. And then there's substantial loss potential as the security goes down, because if the security goes down, owning the right to sell is going to be more and more advantageous for that long put holder. We would be obligated to buy at 150. And if ABC was at $100, that could be a $50 loss, because that's where ABC is pricing and will purchase at an inflated price in comparison to the market. So we'll do the same thing here and see how this plays out. And remember, looking at long equity calls is the best way to remember this, but we'll go through the put side as well. So very similar scenario. So I'm buying one ABC put expiring on May 20th at a strike of 150 for 7. The long put purchaser is bearish in this situation, and they have a $135 price target and a 30-day time frame. The short put writer is neutral to bullish. So it's not necessarily just bullish. The stock can remain at 150 and it would still be worthless. Therefore, it's a neutral position. And say they've got a 155 price target within this scenario, within a 30-day time frame. So in order to create this trade, the long put purchaser is going to buy to open one ABC 150 May 20 put at $7 and pay a premium of $7 per share, 700 total. The short put writer is going to just do the opposite, receive that premium, $7 per share or 700 total. So let's see exactly what happened. And remember, the break even is the same. It's the difference between, it's $7 below the premium paid for the strike price. So 143 is the break even. So let's say ABC went to 140. The long put purchaser is close to their price target. So they've decided that they're going to sell to close that ABC 150 May 20th call at 11. Because remember, this is an expiration and there is some extrinsic value priced into this. So they received a gain of $4 or 400 total. The short put writer, remember, they face substantial loss potential. So if the security was to continue to decline, they could lose quite a bit of money. So perhaps in this situation, they decided they were going to buy to close their option and prevent and mitigate any further losses. Therefore, they have a loss of $400 per share. So the difference of the 1100 and the 7. If you look at all the way till expiration, and let's say ABC was at 135 and did hit the long put purchaser's price target. In this scenario, it's worth exactly intrinsic value. So if I have the right to sell at 150 and the market's at 135, it's worth $15. They made a gain of 8, and the short put writer made a loss of 8. So just the difference of those two. And I know I did spend a lot more time on the equity calls because I want to make sure we save some time for questions at the end, because there is certainly a lot of information in here. So then going through that scenario again, I want to make sure you see what it looks like from both ends. So let's say we actually just reached our break even on day 15. So remember, day 15 means time value is still priced in. The long put purchaser was able to sell to close their option at $9 and received a small little gain. I'm sorry, this was a typo. All right, so what I want you to take away from this, and this is an important piece from going through everything that's there. Long calls are important to understand from an options 101 perspective. It's purchased for a premium and it contains the right to buy the underlying. You need the stock to rally more than the premium paid. The long put is just on the other side because it contains the right to sell. You need the stock to decline more than the premium paid. Therefore, both of these profit from sharp movement. You need movement up or down, and you need quite a bit of it because of that premium paid. And time decay does not benefit the long option holder. So time decay is negative. For the short put and the short calls, they contain the obligation and they're sold for a premium. They profit from neutral to downward movement, or excuse me, neutral to some movement. The short call downward, the short put upward, and time decay is actually positive because that's the depleting component of the options contract. It actually has a positive benefit because your goal is to buy it back at a lower price. And do know that a lot of these are put together to offset risk. These are the riskiest positions, and these actually have their own risk as well. So there's certainly a lot of ways to optimally choose your strike prices and your expirations. The purpose of this entire webinar was just to get you comfortable with the anatomy of an option and how pricing works. And essentially that's it. So there is a lot more that goes into it as far as understanding how to optimally choose your strike price, how to choose which expiration. Notice that I used a price target with those examples, and that's because it's one of the most important things when trading options is having a exit strategy in mind, knowing if you're bullish or bearish or where you feel the security is going to go, and a price target. I can't stress that enough because it's not a stock, which means it has an expiration date attached, which means it's going to cease to exist at some point. Something I did want to share with you, since this is a TMX event, you guys do have free to you the covered call opportunity reports and the short put opportunity reports. I'll just put those QR codes on the screen and you can take those, but I do want you to know that those are available to you because we did this with the TMX. And I know we didn't cover a covered call or a cash covered put, but that's essentially the short call and the short put, but just being covered by something else. So technically the covered call is a bullish strategy. And then here's the QR code for that. And I do want to share with you the OptionsPlay platform as well. Just know that you've got those free analytics to you, and you can also check out tmx.optionsplay.com and sign up for a free trial where there are ideas, a lot of education. We give them out monthly options education. We've actually switched that to moving that cadence to more weekly, and we have market outlook sessions. So we do about 3 to 4 webinars a week on various topics, and we do offer exclusive access to OptionsPlay Canada via those QR codes. So with that, I am going to hand it over to Jonathan, and we can open it up for questions.
Firstly, just want to say thank you so much, Jessica, for that very engaging presentation again today. I know I learned a lot, and I hope our customers were able to learn quite a lot too. So we're now just going to move on to your questions and answers. Thanks again, everybody, for your patience. So first question here from an anonymous attendee, and I know we can't give any advice, but what is the best kind of rule of thumb for buying and selling contracts when it relates to your implied volatility? Is there a certain amount of implied volatility where you probably shouldn't be selling a contract, or maybe there's an optimal amount of implied volatility where it might be a good time to buy a contract?
I love that question. So implied volatility is something that we look at quite a bit. I prefer to look at implied volatility rank, or that will give you an idea if you should buy or sell it. So remember that options pricing component. If you have something with higher implied volatility, it's not optimal to buy. You are actually going to capitalize more from the premium side. But I will say, we talked about individual contracts. So that's not something I would ever do with a naked call or a naked put, because that is excessive risk. But from a pure volatility perspective, as long as it's not something maybe around earnings, like you have to know why it's there, but lower implied volatility is going to be better if you're buying options because the price isn't overinflated, and higher implied volatility is going to be more beneficial if you're selling options because the price is inflated and it's going to deflate, and therefore you can capitalize on that.
Perfect. Thank you very much for that thorough answer. I know that definitely helps us make some more informed decisions. And As you mentioned earlier, today's session was more of an introduction on the anatomy of an option, how options are priced, and kind of generally how they're traded. So in the future, if there is interest, we will be having more intermediate sessions and more in-depth option sessions. So keep an eye out for that. And if you have any feedback, please submit it in the post-webinar survey as well. So a couple more questions here to finish things off. This one's, I guess, a little bit more related to OptionsPlay specifically, but I guess we'll cover it. Do you have an S&P 500 options course available or something specifically for, I guess, US options, maybe NASDAQ, things like that?
We offer quite a bit of courses, and we do sometimes center them around index versus ETF options because there are certain advantages and disadvantages. So we do them based on index and ETF. We do have a course that's in there. Our options course content is honestly about it's about 12 weeks long, so it's very, very extensive. So there is 1 hour that we do spend talking about the difference of ETF and index options. So not necessarily just the S&P 500, but really in general.
Fantastic. Thank you very much. Just a quick request from a couple of the attendees. Do you mind just going back to that slide with the QR code again, with the covered call opportunity report and the short put opportunity report? I think it was right before this one. Perfect. Thank you so much. Just in case anyone wants to scan that code and grab it for their reference. And it will be available in the recording as well for later on. Thanks again. So let's finish off with a couple of more questions here. So does implied volatility affect calls and puts the same way on the same underlying, same expiry, same strike price, and same security? So would a call and a put be affected the exact same way with the implied volatility?
Oh, such a good question. The answer is no. And you can actually use it to look for a skew. So meaning there could be higher implied volatility, giving us an indication of a bias of upwards or downwards potential. So you might see higher implied volatility on the call side, or you might see higher implied volatility on the put side because people are, remember, it's an anticipated movement. So if the market is anticipating a upward movement, you may see higher implied volatility on the call side versus the put side. And that also goes with different series, which means expiration. So implied volatility varies quite a bit, but you can utilize that to really gauge sentiment, to gauge earning moves, to gauge if there is bias to the up or downward side.
Perfect. That definitely helps. And I'm just going to ask one of my colleagues to post a link to our Introduction to Options guide as well on the Questrade website. That does have a nice section on implied volatility and how it can affect your different put and call contracts. And as Jessica mentioned, they do have more in-depth events on their side, and we will be having more events on our side as well. All right, let's do one more question here to wrap things up. I see a lot of Questrade specific questions, so I'll leave that to my colleagues to answer via text. And let's see, maybe we'll do two. So one quick question, is it possible to modify a contract? Can a put or call be modified once it's been bought or sold, or once you've kind of bought it, once it's out there on the market, that's it? You either have to cover it or sell it back.
Yes, but I think that leads to a really great point. You can close and open a new contract, and that's called rolling, and that's a type of repair. Or if the option doesn't move your way, you can adjust, which is a whole different conversation. But yes, it's once it's there, it's done until you close it. But you can close and reopen another, essentially creating different price targets in a different position and adjust based on your outlook of the underlying security.
Exactly. And you can do this to mitigate risk, all sorts of different things with rolling over strategies, rolling up, down. So we'll definitely cover that in more detail if there's interest. All right, let's go with one last one. Yes, the video will be provided. Let me just quickly reiterate that. And let's leave with this one here. Can you quickly summarize a short equity call again in maybe a few short sentences with really simple terms? We just had some more questions about the short equity call as opposed to the long equity call.
Yeah, I'm actually going to put that back up on the screen as well, just because I think that visualization absolutely helps. But a short equity call, you essentially want it to expire worthless. So it is a neutral to a bearish position. This is normally done via a covered call, which is not the question, so I won't explain it that way. But essentially from it itself, you want the underlying security to not move at all. You would do this if you feel like there isn't much movement. If there was a high implied volatility environment, that could be rather dangerous because this is an unlimited risk potential strategy. So it's more commonly a covered call, which perhaps that does make sense to talk about. If this is a covered call, it actually flips the strategy to the other end, where you actually make gains if the stock moves to your strike price rather than the other way around, an unlimited loss potential. And I'm sure that caused a lot more confusion. However, I think it's short equity calls are just very, very, very risky on their own, and that's the more common way to trade it. So therefore, I think it's better to focus your understanding on the covered call. The purpose of showing it this way is just the other side of the long equity call and how they're a mirror image.
Perfect. I really appreciate that extra explanation. And it really does help to kind of explain that they are, in fact, opposites of each other. Short equity calls are a lot less common, and they're also referred to as naked calls sometimes if you don't own the underlying shares. And as Jessica mentioned, that can lead to theoretically unlimited risk. So long equity calls, a lot more popular, but to understand long equity calls, you also do need to understand short equity calls. Perfect. So we will wrap things up with that here. Thank you again, everybody, for your time today. And thank you again to OptionsPlay, to TMX for coming on and presenting today and for hosting the event. We do have a post-webinar feedback survey. So if you wouldn't mind taking 10, 20 seconds to fill that out for us, we will take your feedback seriously and use it to plan future events. Thank you very much again, Jessica, and have a great afternoon, everyone.
Thank you so much for having me. Have a wonderful day.